So if I don't hear your voices, the classes actually doesn't become interesting. So I want to have an interactive session rather than have a one-way traffic of my telling only, because you are also master students. So that is the thing I want. So you are aware of the basics of derivatives, right?
Yes, ma'am.
Yes, ma'am.
Yes. So when we consider the agricultural commodity derivatives, the primary exchange which deals with the agricultural primary derivatives, I believe you are aware about that. That is the National Commodities Derivatives in Exchange, which we say to be NCDX. Another one is MCX, but MCX is primarily related to the trade of metals and bullions, but agricultural commodities are primarily traded on NCDX. They are the major shareholder of agricultural derivatives trading in India. Now, if we consider the contracts that are traded on NCDX, they can be grouped into this major categories. Just an overview of that. That is cereals, fibers, boar complex, oil and oilseeds, soft, which is only sugar, and spices. And the other one is the index products, which is agri index, which they have termed as agridex. Now, agridex, it is basically an index which have been launched by NCDX this year only. It started trading from May 2020. And it is a composite index which is made of 10 liquid contracts which are traded on the exchange. And since it is a kind of an index, it has a floor and a cap regarding the weightage or regarding the share of each of the commodities or each of the group of the commodities on the index. So it is being made in such a way that none of the group have a weightage of more than 40% on the index, and similarly none of the commodities should have a less weightage, a weightage lesser than 3%, so that their prices are also being reflected, the price movements are also being reflected on the index, because this agri index might be adopted by people, might be adopted by investors or the people who will be investing for diversification. So when they are going for diversification, so the index should be a correct representation of the price movements of the underlying assets. So if it is the case that one commodity is having a very, very less weightage, then the price movement of that particular asset will, or that particular commodity won't be reflected on the index. At the same time, it is being considered that it will consider only those contracts which are liquid. Liquid means for which there is enough trading in the market, because illiquid commodities doesn't carry any kind of information content in it. More the transaction, more the trading on any particular commodity, more the information flow, and accordingly more better is the reflection of the underlying information on the commodity prices. So agri index have been started. It is the first agricultural index to be trading on the Indian market, that is agri index. And any idea which is the most trading group of all of this on NCDX? Any idea you have that there is segregation based on the kind? There are cereal prices, fibers, poor complex, and oil seeds, sugar, and then the spices. Now, any idea which group is the most highly traded one on the NCDX?
Cereals,
Huh?
cereals and pulses.
Cereals and pulses. Anyone, anything else to say?
Spices.
Spices. Okay. Now, why did you say cereal and pulses? What? Because it's one of the most necessary commodities for the Indian market. Food grains. That's why cereals and pulses came to your mind.
Yes, ma'am.
Yes. Okay. And why spices?
Because it attracts a lot of exotic demand.
It attracts a lot of,
Exotic demand.
okay, exotic demand. So why do you think that having an exotic demand pool is important for the product to be highly traded on the market?
Because it is a potential for a lot of foreign currencies and people would be interested in its profitability, and then
But if it is the case of derivatives trading, so there are certain criteria which you need to fulfill to be able to trade on the exchange, right? And one of the criteria for that is that you need to be an Indian national. So how are you relating it to the foreign currency? Can you just explain it a bit what you want to say?
so what I am saying is that people know that it has a lot of exotic demand,
Okay.
and hence they would be interested in trading for that, because so the trade is driven by that motivation.
Because you are thinking that there is an international market for the product, right?
Right.
So the price of the product will be related to the demand and supply in the international market.
Right.
So they will be trading in that.
Yeah, that is
That's what you're trying to state, right?
Yes.
If I have got it correct. Okay. And anyone? Okay, I have got one for cereals, one for spices. And anyone, anything else? Okay. Now, it is not cereals, it is not spices. That is basically the oil and the oil seed contracts. And after that, it is the Goer complex. Now, why it is particularly not the cereals and pulses? Because these are food grains. And there are lots of restrictions on the food grains. They have been suspended from trading for a number of years. Then they have been again brought into trading. So there has been lot of policy changes regarding the cereals and pulses, which makes the trading not very certain for this commodity. So that is the reason for it not being cereals and pulses. Another thing is that I am pretty sure you have heard about the MSPs, right? The minimum support prices,
Yes, ma'am.
right? So this cereals and pulses do have a minimum support price, and their procurement is done under that. So for that reason, the people trading in those commodities, they are not too much interested to protect themselves from the risk, because their risk in some way is protected because there is enough procurement, particularly of wheat and paddy, under the MSP program of the government. And spices, yes, it is it is a liquid contract, but if you consider the volume of trading of spices will be low, because spices, the applications are lower. But oil and oilseeds contracts, India is a major producer, at the same time importer of some of the oil, and particularly the case of vegetable oil, edible oil particularly, we produce also a lot, and we import also a lot. So, and there is a very, very developed market, particularly of the soybean and soya oil and soya meal in the international market. So there is a very, very developed international market for oil and oil seeds. So that is the reason. And there has been this, if I take the example of one, say soybean trading has started from 2003, and it has been continuing in the economy till now without any suspension. Though soya oil and soya oil particularly have been, and castor seed have some restrictions, some suspensions in some time, but soybean has never been suspended. So soybean is one of the most highly traded commodities in the Indian market. And so the oil and the oil seeds complex, they actually constituted the major portion of the trading in the Indian market, and followed by Goer complex, which is basically Goer gum, which is highly needed by the industries for adhesive. It is needed in the, and thickening agent. It is needed in the industrial sectors like food and beverages. At the same time, it is needed for exploration of oil from the refine and in the refineries. So it is also related to the crude oil demand, to some extent crude oil prices, but there is a huge industrial demand for Goer, and we are not one of the major exporters of Goer in the world. So these two are the primary things that are being traded on NCDX. In addition to that, so since I am not concentrating much on MCX, so there is Mentha, which is traded on the MCX, which is a highly traded commodity on the MCX of the agricultural commodities. So if you consider the product-wise performance, that which are the commodities which have traded well in the financial year 1920, we all know that The last quarter of 1920 has not been well because of the pandemic situation which started, and commodity derivatives market is not exceptional to that. The commodity derivatives market also suffered the impact of that, and the turnover on the index have dropped down significantly. But there have been some commodities which have been done well, as is mentioned in the fourth point, that is refined soy oil, soybean, RM seed, and wheat gained slightly. Most of the commodities had negative return. And one factor for the impact on the Goa complex, on the Goa seed, that was falling crude oil prices, because I told you that the Goa complex, Goa seed is needed for the oil industry, and the falling prices leads to a decrease in the demand for that, though there was demand for the food and the beverage industry. And it experienced an average daily turnover, which is mentioned, which is lower than what was there in the previous financial year. And as I just now told you, oil complex, which is the oil and oil seeds, they contribute about 47% of the share of the turnover of the exchange, and we followed by Goa of 24%, and then followed by pulses and cotton. And among the, if you consider the individual commodities, then yes, the Goa seed has the highest share, and then followed by soybean and refined soy oil. And the other major contributors are this, that is chana, guagam, cotton seed, oil cake, and RM seed, and coriander from the spices. So if you consider over here, this is just data from the NCDX annual report, that it is based on the performance of the different contracts being traded for the financial year 1920. And you can see that only this four, that is soy oil, RM seed, wheat, and soybean, they had positive returns. The others had negative. Particularly, it was caused due to the period from January to March, the last quarter, because of the outbreak of the pandemic at that point of time. And here, which I just now told about the share of the different commodities on the trade, that is.
Is there a connection problem?
Yes, sir.
Yes, sir.
I think her line is off. Let me check.
Is the screen visible?
Yeah.
Yes, ma'am.
So I was on this slide, which was the trend in in the volume of trading. So these are the number of traded contracts from January to October. So very, very easy to say a particular feature is observed, right? For all the contracts, which is visually should be clear to all of you, that there is a particular feature that is observed which is common for all the particular contracts. This is the data from January to Friday. Till Friday, the data is there. So what do you observe in this?
So during lockdown, the number of traded contracts is less.
Right. It's simple. So during the period of lockdown, the trading of the commodity exchanges also suffered. It is not that the agricultural contracts didn't suffer, unlike it also suffered like the stock market trading. So if you observe over here, these are the top trend contracts which has been traded on NCDX platform as on 9th October, which is still Friday. So these are the top 10 contracts traded with regard to the number of contracts being traded. Now, whenever a contract is being traded, you know that it is being traded, it is being specified with the expiry date. So the number of contracts traded for soybean is 6-month contracts are traded. For soy oil, also 6-month contracts, and for majority of the other commodities, it is actually 3-month contracts. So now, whenever a contract is being traded, it is on a particular day. There will be multiple number of contracts being traded of a particular commodity, of a particular symbol, and the expiry dates will be different for all those particular contracts. Now, if you consider here, if you see here, the top 10 contracts traded as on 9th October, there is a particular feature which is common to all the contracts traded. What is it? So we can see that the commodities are soybean, guar seed, chana, soya oil, guar gum, which is again of the guar complex, mustard seeds. So which I already mentioned, the major commodities are from the oil and oil seeds and guar gum. That is oil complex and guar gum complex. So that is visible that they are the most highly traded commodities on the platform on a particular day. But there is one particular feature of all the contracts which is visible. Can you just identify and tell me what is it? Of all the contracts traded, they have a commonality. What is it? Can it be told? These are the symbols. If you know that all the commodities being traded, they have a particular symbol. So like guar seed 10 has this, and similarly there is a guar gum also. So obviously depending on that, they have the symbol. Depending on the quality of the commodity and the commodity, we have different symbols being assigned to them. So based on that, these are the tradings. Obviously we have the open, high, low and close price and the spot price. So the spot price is the price which is the polled spot price as released by NCDX. So the price is polled one from the different mandis where the commodity is being sold. So it's a polled spot price, and then the quantity traded, and the units are in million tons, and the number of contracts being traded, and then the traded value. Now, all these contracts, they have a particular feature which is common to all the commodities, to all the contracts which has the highest traded number on a particular day. What is it? Can you identify that? Can that be identified? Very, very simple. Look at the table and you will be able to see it. There's a particular thing which is common.
Their spot price is very close to open, high, low.
Their spot prices are very close to open, high, low. Okay. Other thing, it shows you are stats people because your eyes goes to the numbers. Other than the numbers,
The units is in metric tons.
no. All the agricultural commodities are being traded in metric tons, and one lot size for majority of the commodities is 10 metric tons or like that. So that's the unit. One lot size is, and like for soybean, it is 10 metric tons. So that's not actually the important thing I am looking for. I told you about one thing, that at a particular point of time, there are certain contracts that are being traded, which is based on the expiry month of the contract. Like today is the month of October. So now there will be the trading of October, November, December for majority of the commodities, and for soybean, October, November, December, January, February, March, 6-month contracts. Now, if you see the expiry, the highly traded ones are the contracts which are in the month of November. Isn't it so? It is not the case that only the November contracts are being trading. At a particular point of time, for soybean, there are 6-month contracts that are trading. Similarly, for soya oil, also 6-month contracts. For guar 3-month contracts. These are being trading. Out of all of them, the highly traded one have the expiry of the month of November, right? Did you observe this?
Yes, ma'am.
So why this is so? Because those are the near month contracts. So basically, whenever a contract month is being reached, suppose this is October. So whenever the contract which is expiring in October, the month will be reached, say 1st of October, the people holding the October contracts will actually go and square off their position in the October contract and go to the longer term contract, say the November contract, because then that is the near month contract. So that is why the most trading happens in the near month contracts. People keep on changing their position, which we refer to as spread contracts, time spread contracts. People keep on shifting their position from one contract to the other. It is a shifting that happens. So that is why the trading will always be more on the near month contract. So that is why you will observe that the highly trading contracts in the month of October will be the November contracts, because people will be extending their um, positions in the market by shifting from the October to November contract. Because whenever a contract reaches the expiry month, there are certain specifications that is, I will discuss those. They are referred to as the tender period and notice period. So if the month and each of the contract on agricultural commodities, the expiry is usually the 20th of a month. But if the 20th of a month is a Saturday or a Sunday or it's a holiday, then the previous date happens to be the expiry date of the contract. So either it is a 20th or a 18th, like that, the contract dates have been there. Now, once the contract date is being reached and the position and the holder of the position, say, you know about short and long positions, they are still holding the positions. If I have gone short of the contract, I want to sell the commodity and I have not closed my position on a particular contract, I will have to make the delivery of the contract. The commodities contracts, they have compulsory delivery. So compulsory delivery, if you don't close off your position before the expiry date of the contract. If you have open positions, even on the day of the contract, sorry, even on the expiry day of the contract, you will have to make the delivery of the commodity. And if you are not able to make the delivery of the commodity, there is a penalty for that. So that is the reason majority of the futures contracts, they are actually till date not physically stated. The number of physical settlements of trades that are increasing, but till date majority of the trading is cash settled. So people close up their position in the derivatives market and say sell or buy it from the spot market. So if they could have been able to gain from the spot market, obviously accordingly they will be having the benefit of that if they have been able to predict it correctly. So that is the case. So majority of the tradings on a derivative exchange till date are cash settled. They are not physically settled. But if there is any open position on the expiry date of the contract, delivery becomes compulsory. And if delivery is not being made, it calls for some kind of penalty as imposed by the exchange. That is why the majority of the tradings will always happen on the near month contract. That is why you are seeing it to be 2011. That is the near month contract, the contract which is expiring in the month of November. And another thing, since obviously you are stats people, you will be working with data. So whenever you are working with the futures price of the contracts, so always keep it on point that whenever a particular month is being reached, that is October, for the month of October, go on to the next month's contract for your study, which we refer to as the rollover mechanism. we roll over to the next month's contract, because this, in the month of October, people will be squaring off their positions in this particular contract, which will lead to much of volatility in the particular contract. So that is why for your study, when you will be doing analysis, when you will be doing with, if you want to do with commodity futures prices, so always use this rollover mechanism. Say in the month of October, the near month contract will not be considered to be the month of October contract, to be the contract expiring in October, but it should be the contract which is expiring in November. That is what we refer to as the rollover mechanism. That is what we consider to be the near month contracts. Similarly, over here, the top 10 gainers in terms of change in the price of the commodity, that also you will observe it to be this, which belongs to the oil and oilseed complex and the guar complex. So these are the ones which have got some kind of positive return as on the 9th. This is the date. This is only one period. So this is as on the 9th of October. So now, as I was telling you about the NCDS Agri, it is based on the agricultural futures index. So as I told you, which tracks the performance of 10 liquid assets, which are 10 liquid commodities, which are there on the platform. And as I told you, there is a floor and a cap on the percentage, on the weightage percentage of the commodities, that is individually and as well as a group. So that is how the NCDX Agri is being calculated. So obviously it is a Agri index which has been launched mid the pandemic. So it has been launched on 26th May. And obviously over the entire period, the trading of that index has been coming down drastically. And it has not picked up because it was just launched in the period when we were already facing the kind of pandemic. So when we are considering the commodities to be selected on the as a part of the index, so they are based on the liquidity of the particular commodity as well as the importance of the commodity with regard to the Indian market and as well as the global market. So for a commodity to be eligible for inclusion in the market, there are certain criteria. So it should have traded, because it is liquidity, so it should have traded for at least 90% of the trading days. And as I told you, a cap of 20% and a floor is enforced for individual commodities. And for a group of commodities, the maximum weightage that can be there for a group is 40%. This is done so that each of the commodities do have a proper representation on the index, and these are the commodities which are being considered, and that this is the weightage of the commodities that has been decided for the year 2021, which is based on the production, that is average estimate of production of the commodities during this period. Based on that, this has been calculated. So that is the commodity weights they have decided for this particular financial year for the Agri index. Obviously, if there is certain changes, there will be rebalancing, but that rebalancing will be done based on what has been the trading and what has been the prices for the previous months. Now, whenever a contract is being trading on the market, there are certain specifications that are mentioned. So obviously, the most important specification, if you open a particular contract, is what is the type of the contract, whether it's a futures or an options, what kind of contract it is. Then we have the name of the commodity. I have not mentioned everything in this slide. I have mentioned the ones which are have some definitional or have some meaning, because the others are clear, like name of the commodity will be mentioned, ticker symbol will be mentioned. So each commodity has, based on its quality specifications by the exchange, to have a ticker symbol. So like we saw in the earlier slide for these commodities, these are the ticker symbols. So the ticker symbol will be mentioned, and the trading system will be mentioned. Now we come to the basis. Now, whenever each commodity is being in the contract, there is a mention of the basis. Now, what is basis here? Basis in terms of future basically means the gap between the futures price and spot price, but this basis has nothing to do with it. This basis basically means the basis center, which is the center to be referred uh, for the particular commodity. Like for soybean, the basis center is Indore. In addition to the basis center, there will be other associated additional delivery centers also for the particular commodity. So the delivery centers are based on the godowns and the warehouses that the exchange has over the region, and the order and the if it goes up to delivery, it has to be taken from those warehouses. So that is what is basis. Unit of trading basically means the lot size, like 10 million tons is one lot of a particular commodity. So that is what unit of trading is. And delivery units, then the maximum order size is based on, it is determined by the exchange that what can be the maximum order size of a particular individual who can be a member of a particular organization or who can be a client. So that is it. And then the quotation or the base value is being mentioned. Tick size. So what is the tick size? You people are doing derivatives. So what is meant to be the tick size? We say up tick, down tick. What is meant by the tick size? Are you guys there? Have any question till this?
If there are any questions, you can ask them now.
No,
Any
I
questions,
was asking what about the tick size? Do they have an idea about
And
tick
yeah,
size?
so do you know what is a tick size?
Yes or no, say something and then I will continue.
Maybe it's a commodity size.
It is a bit louder. Can
The
you
amount of commodity they require.
amount of commodity
The share, basically the number of shares.
means the quantity.
Price change.
Price change means
Minimum price
Means
change
how
that we
much
can-
it can change, at least.
Because a tick generally represents a particular code of a particular commodity, right?
your voice is not clear to me.
There is some audio breakage. Akash, I
Yes,
think
that's why
your
I can't
Hello.
hear him.
audio is breaking.
Yeah, I was saying a tick generally represents a commodity, right? Like a code for a particular commodity.
Commodity.
No, I guess
I'm not sure.
Someone told something about
I
price.
guess
Who was
that's a
It's
tick.
kind of minimum price movement,
right?
which can
So it is the minimum price movement or the minimum incremental amount out at which you can do a trading. So as compared to the previous trading. So that is the tick size. So that is, there is a specification about the tick size. And based, so if the current trading is above the previous trading, we say uptick and accordingly downtick. So it is related to the price change between two subsequent trades. So there is a tick size which is mentioned by the exchange. So there are quality specifications where actually the Indian farmers do suffer, because there are specifications that needs to be fulfilled in order to be eligible for trading on the market. So there they accept variation within a certain percentage, that is also mentioned in the contract, and the delivery center is being mentioned, and tender period. Now in the particular contract, there is a mention of the tender period. Tender period is basically related to the delivery month of the contract. The tender period is the period during which, if anyone is holding a long or a short position, they can make any changes. They can have they can submit the intention to deliver the commodity, or submit the intention to take the commodity. So once the tender period is over, then there is nothing that can be done. So there is a tender day which is being specified for a contract for the agricultural commodities traded on the NCDX. The delivery date, the tender date is basically the 11th of every month. So now once the tender date is there, within 2 days, the pay in and the pay out of the commodity has to be done. So based on whether you have a short position or a long position. And the price limit is basically based on the limit within which the price is allowed to vary. So the range within that. So if the price reaches that limit, then there is a stop for 15 minutes, and again the price limit is being increased, and then the trading starts. And the position limits are the limits that are being stated by the exchange, that are the number of contracts that a member or a client can be have the position on after netting off all the positions before the expiry of the netting off means cancelling all the positions as on a particular date. So what are the position limits? And there are margins that are being mentioned by the exchange. So when we consider margin, there is an initial margin that has to be deposited before you start trading. So how much will be the initial margin? It is based as a percentage of the trade, as a percentage of the value of trading that you will be having. So you need to make certain percentage of that as margin before starting the trade. And in addition to that, there will be special margins might be imposed on a commodity, which can be imposed by the exchange at different points of time, depending on the volatility of the commodity. So with regard to the special margin, there is one thing which is the delivery period margin. So this delivery margin actually increases as the expiry date of the contract approaches. So once the delivery margin is being imposed, that particular contract is being exempted from all the other margins. So that is one more important thing with this delivery margin. So delivery margin is being imposed basically so that there can be reduction in the speculation activities that can happen when the contract matches approaching the expiration. To reduce that, there is a margin which is the delivery margin, and special margin, as I discussed, it depends on if there is certain changes in the price movements of the commodity. And there is the final settlement price. Those final settlement price is actually based on what has on the average of the prices on the 3 days, including the day of expiry. So based on that, the final settlement price is being decided on based on the 3 days of trading. And if there is, suppose there is information on the days of trading, means based on the spot prices that are there on the days of trading, including the current including the day of trading. So if suppose there is information on only 2 days, then the average of that, based on that, the final settlement price is being decided. So now I just wanted to show you give you an idea about the NCDX. So
Any problem with the connection?
it's opening, I think.
Oh, okay. Okay.
buffer. I have done the screen share, it is not open.
So I think the screen share is only for the presentation.
Yes. Change it.
So you have to stop sharing and then go in
Then
again.
I have to keep sharing. Just tell me if you can see the NCDX link. I have to stop sharing that.
Yeah, it is showing. Can you all see this? The NCDEC page?
NCDX page.
Yes, yes.
Yes, sir.
Yes. So basically, I wanted to show this because later on when you want to work with the data, you can. So this is the link for the market data. So there is a BHAF copy over here. So the BHAF copy actually gives the details about the trading for a particular date. So if you just click on the BHAF copy link, suppose I select today's date, or say since today it has just started training, so I will select Friday's date. So if you just select this, there will be an Excel sheet that will open that will have the details of all the
So is the connection gone again?
Yes, sir.
Yes, sir.
Oh, let me check again.
I shared the screen.
You can share.
Share screen.
You are not able to share?
No, I am only having the open in my that's what it shows. This one. Now it's there.
হ্যাঁ সুরঞ্জনা, স্ক্রিন শেয়ারিং কাজ করছে?
হ্যাঁ কাজ করছে কিন্তু শেয়ার হচ্ছে না, আমি শেয়ার করে দিয়েছি
শেয়ার হচ্ছে না।
পিপিটি।
আচ্ছা দাঁড়াও এক সেকেন্ড।
হচ্ছে না।
ওকে দেখো তো হয় কিনা, আমি আরেকবার
না ওটা এখানে দেখাচ্ছে ঘুরছে, বাফারিং সাইন দেখাচ্ছে।
ও বাবা,
বাফারিং না কি দেখাচ্ছে বুঝতে পারছি না। পিপিটিটা তো আমার এখানে খোলা।
no, it's not working. তুমি কি ইমেল করবে?
So the connection got withheld. Okay, as I was showing the NCDX page, therefrom you can get the data if you later on walk through. And NCCL is basically the clearing department for NCDX, who clears and settles all the trades that happens on NCDX. So that's the source of data. Now, as I was telling about the open position limits, so whenever there is a trade being happening on the NCDX platform, you will find that when you get the data, you will find that there is open, high, close, open, high, low, close prices. At the same time, there is traded number of contracts. Another thing which is very important, which is related to the open interest, which actually speaks about the open positions on a particular of a particular contract as at the end of the day. Now, when we say open interest, it is very important because it is considered to be a proxy for having an idea about the hedging position in the market, because it is considered that the long positions will be held particularly by the people who have interest in the underlying assets rather than by the speculators. The speculators will be the ones who will be holding relatively short positions on the contract. So whenever we try to see the impact of trading activity, one proxy variable to have an understanding of the hedging activity in the market is considered to be the open interest. So currently the contract having the highest open interest is the one which is we discussed having the highest number of trades. It is the SWABI 20th November contract, which is also having the highest open interest as on the 9th of October, which was Friday. Now, when we consider the open position limits, the open position limits is also mentioned in the contract. There is a specification regarding the position limits of members and clients. So in respect of spread trades basically, which means time spread trades, when you offset the position between different months. So you square off the position in the October contract, take a position in the next month contract. So the positions in the same contract or the contract on the same commodity shall be netted off. So that's how the exchange calculates the positions. They nets off the position you have, long and short positions you have. Based on that, they get the overall open position on a particular contract. So the net positions in excess of the offsetting position shall be subject to the commodity level, and on near month position limits as may be stipulated, as may be changed from time to time by the exchange. Now, if you consider this example, so we are considering three symbols. There are 3 months contracts, February, March, and April. So the person has 150 long position for February. For March, it is -30, and for April, it is -80. So considering all the months, the overall open position that the person has is 150 minus this 110. Similarly, here he has 70 as the short, then 45 long. Accordingly, you will get -150. And similarly for symbol 3.
Sorry, Suranjana, can you go full screen?
Full screen, yeah, that I can do. It's now full screen.
Yes, it is full screen now.
So it is the case of long and short positions. So accordingly, this is how the netting is being done. The long positions and the short positions are offset against each other for the different months, and accordingly, the open position is being calculated for a particular member or for a particular client. Now, the position limits are different for the H code and for the member code. So the H, if a person has a H code, the position limits will be different as being set by the exchange. So in this particular case, if you consider the near month opening position after doing the net off, the netting off date is there on a particular month which is the expiry month. So the netting off is also done usually 5 to 7 days prior to the expiry of the expiry of that particular contract of that particular month. So near month open position after netting, it is 40, 150 to be the long and 110 to be the short, so 40. Now from here, it is for this particular, after netting off, it is left with -25. So here you can get that -45 is there, plus 75. So in this particular case, it comes to be 0. So the total near month open position after the netting off is done is 15. And this is the near month. So for what is for the next month. So accordingly, overall netted position is being calculated. So that is how the position net of positions is being calculated, or open positions are being calculated. So when you see the open interest, so the position limits are being calculated, and then we get the open interest. So here, if you see the total near month long is obviously 150 for symbol 1, and similarly -70 for symbol 2, and -135. So total long position is 150, and the total short position is the summation of these two, so 205. So the client level near month open position will be the higher of the summation of the long near month positions and the summation of the short near month positions, the higher of the two. So in this case, it will be client level position will be 205. So now this, I have shown you the calculation of open positions because the open interest do have an impact on the futures price volatility of the particular commodity. It is being said and it is being observed that because open interest is related to the trading activity, which is related to the hedging activity. So if there is an increase in the open interest of a particular contract, there is a decline in the volatility. And on the other hand, the trading volume is considered to be, if the trading volume of a particular commodity is very high as compared to the open interest, it is considered that there might be too much of speculative activity in the market, which can lead to the increased volatility of the prices. So the coefficient is usually, as per the theory, it should be positive for volume and negative for open interest. So this is basically a study done based on the Swabine, and it was observed that yes, if there is an increase in the open interest, this coefficient is found to be negative, and this is to be positive, showing that open interest, how it has an impact on the volatility of the market. So open interest is related to the hedging activity of the people in the market. So more the number of hedgers, more the current flow of information in the market, and obviously that more will be the stability in the market. So that is why the open interest is very, very important. So now the major problem with any of the commodity indexes for agricultural commodities, be it few commodities on MCX or NCDX, it is basically the lack of farmer participation on the exchanges. Now there have been many initiatives done by the exchanges, for this case NCDX, for aggregation of the farmers. The farmers primarily don't operate on the exchanges because their produce is so low and the lot sizes are so more that they cannot. So there have been many farmer producing organizations which have come up and which have been approached by NCDX in order to aggregate the farmers, and it is continuously increasing from the year 2016 onwards, and there has been an increase also in the participation of these FPOs on the exchanges by aggregating the producer or production of the farmers. As per the current strategy of the government, also they want more and more involvement of the FPOs in order to bring the farmers on the exchanges so that they can protect themselves from the price risks. And as per the financial year 2019-20, there are 36 FPOs who have been representing around 2,63,000 farmers, and they have been trading on 10 commodities and with a quantum of 3,700 metric tons. And 11 FPOs have been observed that they also use the exchange not only for trading, not only for cash settlements, but they also use it for the delivery system. They use the exchange warehousing system for deliveries. So there is an expectation that this further involvement of the FPOs will bring on more and more farmer participation on the exchanges, which will actually help the farmers to get a reduction in their price risk. So this is the basic thing about NCDX. Now, which I wanted to actually show was the website of NCDX and NCCL, where it got actually disconnected. So I will just share that particular screen of NCDX and NCCL to show you that how it can help you to understand the market and understand the contracts which are being traded on the exchanges. So, just tell me if you can see the screen.
Yes, it is visible now.
The NCDX website. So if you, this is the NCDX website. So as I was telling, you can get the data on all the different commodities that are being traded on the particular exchanges. So the market data, as I was telling, the Bhav copy is the most important data source for getting the information on the quantum of commodities being traded on the exchange, their close price, open, high, and low price, the number of contracts being traded, and the open interest. But the problem with this Bhav copy is that it is available for a particular day. So it is not that you can get the Bhav copy for a range of date. If you can see the screen, it is only for a particular date. So that's the problem, but it comes as the information on all the commodities which are being traded on the exchange. So it does not show only for a particular commodity, including the agri-dex futures which are being traded. It gives an information on that. Similarly, you have the future quotes, which is just the current day future quotes. And if you are interested to know what are the margins that are being there for the different commodities, the margin requirements that is basically shown in the daily margins. So what is there? What is the margin to be maintained by each of the commodities? So if I from here select a particular commodity, say the cottonseed oil cake. So if I want to know the margin from this date to this date and submit it, the margin information will come. I hope you can see that, right?
Can you all see this?
Yes, ma'am.
Yes, sir.
So this is the
Yes.
initial margin, which is being stated by the exchanges. This is the extreme loss margin. So this margin is being based on the measure of value at risk or VAR. So it is being measured based on the value at risk of the different commodities that are being traded and based on the exposure the commodity has. So from there, the extreme loss margin is being calculated. So they calculate this based on that. They state the margin that has to be made by the different traders, and the pre-expiry margin they can charge additional pre-expiry margin on the month of the expiry of the contract, or they might not charge it. So it is based on the decision of the exchanges. So adding all these three, we get the total margin. In additional to that, there can be special margin being called at any point for the long and the short positions or for both the positions. So from here, you can get an idea about the margin. So if you want to study that how margin change has an impact on the trading of a particular commodity, how is it impacting the market? So you can get the information from here. You can get the margin information and have the information that how the margin actually changed. So that this particular thing of NCDX gives the margin information. Similarly, if you are interested to know the volume of trading only, that how much have been traded for the commodities, you can see here, you can select all product, or if you want to select a particular product, you can. And you want the detail, they usually give the data, the range is 90 days. So you cannot extract the data for more than 90 days. You will have to extract that in groups. So if I want to get it from August to October, so if it is month wise or date wise, that depends on your need of the work, you can get it. So if it is from date, just change it over here and get the data. So that's how we can use the different kind of data that is available to see the volume details, that is how the trading has happened over the period of time, including the quantity and the traded number of traded contracts and the value of the contract. You can get the information from here. At the same time, you have the MIS reports, which shows about the top gainers and losers, which I showed from there, top gainers and top 10 contracts being traded. That information is available from the MIS reports. And if you are interested to know that how much have been the have been the delivery intention being submitted by the by the traders in the market, so that gives a summary of the delivery intentions. Now, if you go to the NCCL, which is the NCDX group company to take care of the settlement. So here you can see there is a risk management tab. The risk management tab helps you to know what has been the position limits on the contract being announced by the exchange, what has been the near month position limits, a measure of the volatility. All this information you can get from this particular link, which is the NCCL, which is the clearing and settlement unit for NCDX. So they are the ones who takes care of the entire settlement of the trade. So they are the ones who give the information about the position limits, the margins, and everything. So under risk margin, you can get the information about the daily margin, which I was showing over there. So for any commodity, what has been the daily margin? So dhania is also the index for the agricultural commodities being traded. So like Agridex is the index for trading, dhania was an index to show the performance of the most major liquid commodities being traded. So dhania is the index for NCDX, and you can see how it has moved over the period. So if you are interested in any particular commodity, you can have information about so you need to give the expiry date. Suppose I give it to be the November 20. So based on that, what has been the margin requirement that has been maintained over the period, you can select any particular time period and you can get the margin information also from this NCCL site. So it will be downloaded automatically as an Excel. So that's how the NCCL can give the information. But majority of the information I was from the NCDX, because all the information are there regarding the pay in and pay out details, which are there for the different different traders in the market. So what have been the pay in and the payout details that are also being available over here. So actually I wanted to show the pay in and the payout details, how it comes. So this is the pay in and the payout details as is available from NCDX. So you can get an idea of the companies who have the short positions and who have the long positions. So if I just take the most highly traded commodity on the exchange, which is soybean, so you can have the information on that who have the positions, who have the short positions and the long positions on a particular for a particular month on the particular commodity. So that gives you an information that about the companies also who are the traders on the market who are associated with the exchange who does trading. So you can see that for soybean, a very well-known name is there, which is ITC Limited. So that gives you an idea about the traders also in the market who are having the positions on the market. So this pay in and payout details actually helps out us also to get that information, to have an idea that who are the ones who are taking positions on the market, and what has been the allocation details, what has been their delivery intentions or supply intentions. That information is also available. So from the delivery intentions or the physical deliveries of the contracts over the period, there has been observed that over the period there has been increase in the physical settlements of the contracts. That means there has been use of the exchange warehouse facilities by the traders on the exchange, which is a good indication that it might be attracting more and more FPOs and more farmers on the exchange who are more linked to the actual underlying asset rather than the speculators. So this is what I wanted to discuss, that give you an overview of the market, that how it works, and not exactly the statistical analysis of the things, just to give you an overview that what are the contracts, what are being traded, what are the specifications, how it helps to understand the specification and that things. So this is what I had to share with you all. And I know there have been lot of teachers, otherwise it would have been over a long time back.
Okay, so thank you, Suranjana.
Thank you.
Are there any questions or
Question.
clarifications at this point? Because there are a lot of links that you actually need to look at before you will be able to absorb this information. But are there any immediate queries that you want to put in?
Yes, ma'am. I had a question.
Yeah.
It is that during this pandemic situation, we have seen that in spite of the economy going down, the financial market has seen an unexpected rise in
Yes.
transactions.
Mhm.
So why does that not reflect in the agricultural goods as well? Because the agricultural sector is the least affected. It's supposed to be the least affected
The
sector.
least affected sector, but it has to be the case who are the ones who are trading on the agricultural markets. So that is the thing which it is not that in the agriculture means the derivative segment for commodities has not been impacted. It has been impacted. The trading has gone down on the during the pandemic, but it has started improving because the agricultural sector is much more, like if you consider the oil, like I said, the Guar come is more highly impacted because it is more related to the industrial sector. It is much more used for industrial goods. So that is impacted. But if you consider the other oil and oil seeds that are not being very much impacted, because are you asking me about the trading of those particular commodities, or are you asking me about the commodity in general?
I'm asking about the trading.
So it is not the case that the trading has not gone down. I showed you now there has been a huge down in the number of contracts being traded during the pandemic. Now it has started moving up.
Yeah. So my question was exactly that why is it that the pandemic has made it going down for the agricultural sector?
The pandemic is going down for the
No, no. Why is it that the pandemic has made the agricultural sector trading to go down?
it is based on the traders in the agricultural market. So obviously it is expected that the agricultural market to be more linked to the economy, because there are less numbers of investors who does investing in the agricultural market only for the diversification of their portfolio. So in that case, the agricultural trading is more expected to be connected to the what is happening to the economy rather than the stock market. People have been investing because the stock market started gaining up within a time, right? And it has been going up.
Yes. Okay.
Any other questions? Suranjana, you can stop the screen share now.
Okay. Stop it.
So if there are no other questions, then I would like to thank Suranjana for making time for the
And
lecture.
I am extremely sorry for the glitch that happened, for the technical
So
glitch.
this is something that we have learned, we are learning to live with now that
Yeah.
we are all going virtual. And if you have any other questions later on this topic, you can just ask me and I will pass it on to her and she will reply over email.
Yeah, you can give them we give them my mail ID. They can also send it. I have no problem.
Okay, okay, I'll do that. All right, so then I think we will end the class today, and day after tomorrow, Wednesday 10:30, we have the second special lecture. So bye bye for now. Suranjana, bye, thank you.